Initial direct costs are costs that are incurred as a result of entering into the lease. Examples include costs such as legal fees and commissions, which are incurred as part of the administration process of entering into the lease. The way initial direct costs are accounted for when accounting for leases under IFRS 16 leases is by adding them to the value of the right-of-use asset as part of initial measurement. Let's look at an example. In our example scenario, the entity has entered into a 3-year lease with payments of $100,000 payable at the end of each period. The interest rate is 5%. As part of entering the lease, the entity incurred $2,500 in legal fees negotiating the terms of the lease. Let's look at how to account for this. We can begin as usual with the measurement of our lease liability. Let's stop and think about what we need to consider in terms of our liability. We know we only have the fixed payments each period to worry about as per the scenario. As such, we can simply plot these out per period for discounting. We can calculate our discount factor for each period. This slide has been included for reference. Please pause to read if you need to, otherwise check out the video on simple leases for more detail. And we can then multiply these through to determine our discounted payments and total them to arrive at our lease liability. Let's look at the right-of-use asset now. Let's think about what we need to consider. In this case, we have our starting point, the lease liability. However, we also have initial direct costs. To measure our right-of-use asset at lease inception, we can simply add these two together: the lease liability initial measurement and the initial direct costs incurred. We can post our journal to recognize initial measurement as such. Right-of-use asset and lease liability debited and credited respectively to the extent of the lease liability initial measurement. The initial direct costs can be debited to the right-of-use asset when incurred, with a credit to cash, expenses, or payables as necessary under the circumstances. Moving on, we can now begin working out our lease liability and right-of-use asset schedules for subsequent measurement. Our lease liability schedule will begin with our initial measurement of the lease liability. We can then add interest by applying the interest rate to the opening balance. We can then deduct our payment for the period. This will give us the closing balance for the period, which will be the next period's opening balance. We can follow this through for each year of the lease term. If we have done it correctly, the closing lease liability in the final year should be zero. Moving on to the right-of-use schedule, we can once again begin with our initial measurement of the right-of-use asset. Remember that this includes the initial direct costs that were incurred. Hence, it is greater than the starting point of our lease liability schedule to that extent. We need only to calculate our depreciation expense and deduct it each period to arrive at the closing balance. This is calculated as the initial measurement divided by the number of periods of the lease term. In this example, it is 3 years. Our opening balance less depreciation gives us our closing balance. The closing balance for one period becomes the opening for the next, and we can follow the calculation through each period. Again, if done correctly, the right-of-use asset in the final period will be zero. Each period, we can debit depreciation expense and credit accumulated depreciation right-of-use asset. Journals can be posted based on the schedules prepared. As an example, the first period is shown. Each period, interest expense will be debited to expenditure with the lease liability credited. The lease liability will be debited to the extent of the lease payment for the period, with a credit to cash, payables, or expenditure, depending on the circumstances of the entity's accounting process. Depreciation will be debited to expenditure with accumulated depreciation on the right-of-use asset credited. And with that, we have appropriately accounted for initial direct costs under IFRS 16 leases. Thank you for watching. If you found this video helpful, please like, subscribe. Feel free to comment any topics you would like to see addressed in future videos. Check out financialreporting.wtf for more. See you next time.